Ladies and gentlemen, thank you again for joining us today. Welcome to Abu Dhabi Finance Week and welcome to this Power Panel. My name is Dan Murphy from CNBC and I'm thrilled to be leading this session. Let's welcome our panel again. Oliver Bates, the CEO transforming Allianz, Claire Woodman, the head of EMEA for Morgan Stanley, Sergio Amotti, the architect of the new Swiss superbank UBS, and Dylan Pillay Sangracera, who is steering the $434 billion portfolio at Temasek. So let's dive straight into the conversation. First, we're asking a really simple but really critical question, and that is, where is the growth and where is the risk? So a question for each of you. As we come into 2026, how do you expect the macro landscape to evolve? First, from an economic perspective and an investment thematic perspective as well. Oliver, I'll start with you.
I thought we'd do ladies first normally, but I'll do this very briefly. I think we have 25 minutes. Nothing will change the next year. We will be seeing a quite divided landscape. Politics are a mess. Financial markets go from height to height as long as the money lasts. The question is, when will that change? Not whether, just when. So we are taking a conservative stance on allocating capital at the moment.
Conservative. Okay. Claire, your view?
I do think that we will see continued moderate global growth. And I do think that that is going to be very positive for the outlook. I think that we will see continued slowing of inflation. But as Oliver said, we have to be very alive to a lot of uncertainties. And because of that, I think you see a massive distribution of views about how the outlook will play out. And obviously, we think that the US is a significant, dynamic and driver of how the outlook for 26 and 27 will play out. And obviously, we'll be focused on the strength of consumer demand. And then obviously, of course, what impact do we see in the near term from AI and technology developments?
Sergio.
Biggest, I would say that most likely a continuation of what we saw in 2025. Two big questions open. Is the inflation going to come under control, yes or no? And this is going to be very important to see, particularly in the US, if the Fed is indeed able to cut as the market predicts. I think that there is a risk there. Of course, the inflation is very sticky still. And we need to see better numbers in order to really allow the Fed to go where the market expects. That could be a negative surprise if it's not the case. The second one is, are we going to start to see some cash flows and monetization of all these AI investments? And particularly, I think I would say, it's important to understand if the non-tech industry will start to benefit really from that kind of evolution. So I would say yet again, another challenging year ahead of us.
Dylan.
Well, I think first of all, we're not a macro investor. We're a bottoms-up investor in companies. So equities is where we invest. I would say geographically, you can't bet against the United States right now. So still a significant part of our allocation goes to the US. Second, I think, surprising maybe to all of you is that we find opportunities in Europe. As I said, we're not macro, but you can find good companies in Europe which are globally competitive, and we're allocating more to Europe. We do allocate to China and to India as well. The Chinese market has done well in the last 16 months. And I think, we'll continue to do well into the new year. As you can see the backlog from the IPOs and the flows that are going into China from outside of China as well as from within China. And India is, of course, still strong. 8.2% growth rate is not to be scoffed at. The equity markets was a little bit wobbly this year, understandably because of concerns over the US-India trade issues. But I think it'll settle itself out in the next year. I think the one thing about investors to be thinking about is the balance between liquidity and illiquidity, and whether you're getting paid for the premium that you need to have for illiquidity. And hence, for us, the idea of making sure that for every dollar we invest, half is liquid, half is illiquid becomes critical. One of the things I would just say about the US that impacts those of us who are not dollar-oriented, where our currency is actually floating against the dollar, is that the a weakening of the dollar does impact our returns. And what we've been doing in the last 6 months or 5 months is to actually hedge our US dollar exposure. But because the hedge costs have gone up to about 2.5, 2.6%, we've now brought the hedges down. So the question that comes about is if hedge costs continue to go up, whether we therefore reorientate our allocation towards a higher yielding portfolio to offset against the hedge costs and therefore ensure that the net return is commensurate with risk. And so that's what we're thinking about right now.
So let's stress test some of these views. Ray Dalio told me this morning on my show that we are seeing the AI trade, the innovation premium on Wall Street, starting to look like a bubble. However, he also said that investors should not sell. So how resilient is the premium that we're seeing right now for US assets? And are you seeing any cracks starting to emerge when it comes to the US exceptionalism story? Sergio, I'll start with you because you mentioned that earlier.
Well, there is, this is, as I said, also, I would totally share that view. First of all, I think this US exceptionalism is really, going at the border of, potentially making things not so easy from an economic standpoint of view. And of course, I'm fairly concerned about this development. But again, I think that I wouldn't jump into the conclusion that we are now seeing a bubble in AI, but for sure, uh, I I think many investors will run out of patience in terms of just pouring cash into future potential cash flow, and eventually, again, it's very important to see the implementation phase starting and the non-IT sector starting to benefit from it. Otherwise, everything will stay abstract for too long, and we still have a lot of vulnerabilities in the system.
Claire, can I get your reaction to that as well? How resilient is the strength that we've seen in US risk assets and on the innovation trade?
But there's still very broad-based demand, and in fact, our excellent researchers forecast that out till 2030, there's probably about 3 trillion of demand for data centers. And look here, I mean, we see that there's 6x of growth in data centers because there is demand for faster processing. And actually, where we have highlighted areas that we think will be big focuses and questions are actually around the availability of power to generate data centers. So I think what we're calling the sort of the intelligence factor, labor, power to actually fuel the data center demand, because the demand is there, is where the market will be very focused in the next 18 to 24 months.
Oliver, let me get your reaction to that as well. What's your take on this? Because billions are being spent on AI infrastructure right now. Do you think 2026 is going to be the year when AI actually starts to deliver real world impact here, headcount reduction, and margin expansion?
Margin expansion, I don't know, but I want to react to what we've just said. First, we are probably here one of the most conservative investors. So you may forgive me that along the value chain, we'd rather invest in the shovels. That is the grids, the battery storing technology. It's just long before you talk about data centers. You need the power to have the data center work. And we don't see a lot of that coming yet. You can already see that in the prices. Effectively, data center capacity prices the implicit price of oil at $300, right? So there is enormous price being paid today for energy, and I don't see that being solved anytime soon. So there is a big issue between demand and supply. And if you're on the right side of the energy production and the supply will be doing good, this is where we are spending some money. The second one, we already see AI in our industry. If I talk about insurance and asset management, particularly on the tech side, right? We already use 20 to 25% fewer programmers today. The issue is, can it make it into the real economy as it's been predicted? And there we have some doubts in terms of the speed by which it will arrive. Remember, when we invented the light bulb, it took humanity 40 years. Now we've become a lot faster to adopt, but you need society to accept that. Let me give you an example. We have had self-driving cars now for 10 years, and they're perfectly safe, but humans don't want to use them, right? So let's be a bit careful in terms of the optimism by which we will drive AI into everyone's life.
Final question on this topic, and anyone can take it. Will AI create more jobs than it destroys by 2030? Dylan?
Well, I didn't hear you.
Will AI create more jobs than it destroys by
Aha.
2030?
I think it's a question of sequence and time frame, right? Look, if you think about AI today and the pace of AI of the technology actually increasing significantly, and the use cases, you look at between agentic AI and adoption of AI for revenue generation, look at physical AI as an example and so on. There is, of course, a very significant risk that you will see job dislocation in some industries for sure. The question is, where will the job creation come from? So there will be an imbalance between where the jobs are lost and where the jobs are created. Now, then the question comes as to whether you'll be able to create more jobs than the jobs lost, even though you can't equate between the two. And the thing about it is the speed at which this is going has never been seen before. In every other industrial revolution, if we can call it that, or tech revolution, there has been enough time for you to be able to come up with job creation to offset the job losses. In this one, the speed of it actually may militate against the ability to react fast enough. And the fact remains that the opportunity to react fast enough to take care of those who are displaced actually rests a lot with governments and what kind of policies the governments put in place to actually help to reskill, upskill workers who may actually find themselves in a situation where the jobs that they were trained for are no longer going to be relevant in an AI-infused world. And I think that's really the question.
Yeah, maybe one point. I think that, in many countries, we are facing two topics: demographic trends, taking, basically having a lot of people leaving the labor market. And we need to create scalability and efficiency and productivity. So AI may help us to find, the de facto new people, and the new people are going to be agents, are not going to be physical people. So the social cost in some cases is overly emphasized because we are struggling to find qualified people for certain jobs, and we may need AI to enhance that dimension. The second one is, a big organization like ours, we have between 5 and 7% attrition a year. So how you do it, how you create the topic of AI replacing jobs is most likely going to be managed by managing the in and out in the organization in a different way that you did before. So, for example, two people leaves, only one comes in. And of course, you are eliminating a job. But again, we would need to really face the topic of demographic shrinking, the amount of people that wants to work in our industry.
Would anyone else like to speak to this before I move on?
All been well said.
Happy to move on. Let's talk about geopolitics as well, because as we look into 2026, of course, the Trump era geopolitical play is still intact. That means trade wars, sanctions, and beyond. For my panel, what is the biggest geopolitical risk in 2026? Oliver, you could kick us off.
Yeah, I hope I'm wrong. That is an accidental war extension in Europe. So I hope that for us, being domiciled, I hope that Mr. Putin keeps his cool and doesn't do any more stupid things, particularly in the Baltics. So that's what we are most worried about. Yeah, so that we can get to a peace. And that's not just a truce and a short-term ceasefire, but that gets solved. That's the biggest risk for us short-term because it impacts the world.
Claire?
Well, that obviously is a very serious issue. I would just say that perhaps on the slightly the other end of the spectrum is just seeing trade and business friction as a consequence of geopolitics, because we really hope that Oliver is absolutely wrong. But I think it's more about friction, and supply chains have been repurposed. There's still a lot of work to do, but I think it's the frictions that we wouldn't want to see in the business cycle.
So, Joe?
Well, I would echo Oliver. So I think that the situation in Europe is very fragile, and not to talk about history, but the First World War started with an incident, and we are now playing with fire, very close to the border of the NATO, and I hope some mistakes or incident don't trigger an escalation of this matter. I don't think Europe can stand it. But on the other hand, I also hope Europe realizes that this is the moment to wake up. I mean, the issue, how can we live in such a situation is quite remarkable. And it's time to take control of its own destiny pretty soon.
So, what's your message to European policymakers?
Well, the truth of the matter, Europe cannot just aim at being a big union in terms of economic, in economic terms. It needs to stand up as a geopolitical power. And in order to do that, you need to be able to defend your own borders independently of any other country. And this is not possible overnight, but over the next 10, 20 years, Europe should develop its own defense and its own capital markets in order to be able to really establish the euro potentially as a true alternative to any other currencies as a reserve currency. Right now is not possible. And last but not least, one foreign policy voice. You can't have 27 countries opining on foreign policy in this in the current environment. So it's very important to take control of its own destiny now, tactically, short term, in the most appropriate way, but long term, you need to change a lot.
That's a really key risk. Thank you, Sergio. Dylan, what's your top geopolitical risk for 2026?
So I tend to agree with Oliver and Sergio, right? Hot wars are the biggest issue. Now, one of the things you should bear in mind is that between 1991 and the onset of COVID, the globalized world that we benefited from was based on two things. One is peace and prosperity, and the second was an international rules-based order that governed both trade and the way in which countries dealt with each other. These were the two pillars that actually led to 3 decades of peace and prosperity, the kind of 3 decades that all of us benefited from. Now, on top of that, now we have trade war, effectively. That combination of hot wars and the risk of there not being peace and prosperity and the trade wars is going to put severe pressures on fiscal balances. We put pressures on countries having to deal with their domestic challenges and not just the cross-border challenges. And I think that if you look at it from that perspective, the geopolitical contestation, whether it's between US and China, or other contestation could well arise, is actually a concerning thing. And the world, the rest of us who are all in between are grappling with this. Okay, it's grappling between the fact that we come to wars, the US and China, as the two biggest trading countries of the world, also have a role to play in trying to see whether the world can come into one of peace and prosperity again. And that's the most tricky thing. The other thing, of course, is that as we get more and more of these shocks happening, the idea of protectionism, nationalism, populism, together with fracturing cross-border and in terms of relationships, is becoming more of a reality, domestic and even beyond. And I think that concerns all of us who are investors.
Does the US-China trade war change the investability of the Asian markets?
At the end of the day, it does to some extent, because at the end, if you want to create value, a lot of things come with it, and one of which is cost of capital. If you want to allocate capital to emerging markets, especially like in emerging Asia, you got to do it against a cost of capital, which allows you to get that spread and get a proper return on a risk-reward basis. So trade wars do actually exacerbate that issue, if you ask me. And so, a much more equilibrium between US and China is actually very positive for Asia.
Let's talk about the investment outlook for the year ahead as well. We've spoken about the macro outlook, the economic outlook, key geopolitical risks to watch. Where's the opportunity to actually deploy capital and grow your AUM and grow your businesses? Oliver, we'll start with you.
Yes, thank you for asking. Let me just pick up on Dylan. One of the reasons why I'm here is because many countries need to try to get out of this US-China thing. So we have a strong interest in Europe to be independent, as does the UAE, as does have Japan, as does have Korea. So my personal opinion is in the long run, people will have to redraw the borders because neither we want to be bullied by any side and having to choose sides. And today that's very difficult because we cannot run our military in Europe without the United States. But as Sergio says, we have to. So therefore, I think it's very important for people that think about long-term asset allocation to think about partners to be being less bullied by any of the two. This will be a long journey, but it's very important because we all have an interest to get out of that. That was the wake-up call. So I would invest in that. The second one I would invest in, we have talked too much about AI, US exceptionalism. We go much deeper because beyond the index, there are in Europe companies that are doing exceptionally well that you will never get the performance of if you only invest in the DAX because the average will not give you the proper return. So it's actually the time to go back to proper asset allocation by finding the winners that will do well in a very, very difficult world.
Claire, highest conviction bet in 2026?
So look, I think we've done AI and tech, so let's knock that one off the list. I think what we're seeing when we analyze corporate commentary is more confidence in the business community, and so certainly I think we'll see a continued trajectory of global M&A year on year. That's up 35%, and we'll see that carry through to 26 and 27. So they're positive. And of course, we haven't really touched on private markets yet, but obviously in order to finance continued technology and AI, we will continue to see growth in private markets. So I think they're just some of the areas. But I just would say, coming back to Oliver's point, again, the reason we're here is look at the growth and diversification in the MENA region. I mean, it's really quite impressive, particularly what Abu Dhabi has accomplished over, the last 10 years.
Sergio?
Well, in this environment, having high conviction bets is quite, difficult in my point of view. I have a hard time to think about any asset class that is not fairly priced or overpriced. So my only conviction is that diversification is the only way to try to navigate this very complex environment. I would say that a healthy portion of cash ready to step in if you have some discontinuity in the markets is quite a good strategy for the next 12, 24 months. But also on a positive note, I do believe that some of this technology, some of this innovation that we start to see will start to show results in terms of economic benefits, particularly, in the efficiencies part of the equation. I'm not so convinced yet on the top line dimension, but for sure, the front to back processes of any large organization can be reshaped. And that could create a little bit of tailwind to valuations and earnings. But I would say the name of the game is diversification, and I would be careful of having too high conviction on anything right now.
Very interesting. Dylan, what's your view? And on that, what do you think will be the best performing asset class of 2026?
On a risk-adjusted basis, right?
Sure.
Look, I actually think that if you're focused on how to invest in private credit and core plus infrastructure as diversifiers against equities, I think you can end up in a good risk-reward equation. Okay, so we're long on equities, right? Because we have 95% of our portfolio is equity. So if you want to diversify against the performance of equities, whether on private or public, then I think you got to think about what is it that actually allows you to do so. So in private credit, you're further up the cap stack, for a return that gives you a cash yield, especially your focus on cash yield. And the same thing with core plus infrastructure, right? Because underwriting cash yield and stable earnings over periods of time. And especially with asset classes where there are long-term contracts which are bankable, it helps you actually get to where you need to get to on a risk-adjusted basis.
Okay, very interesting to watch. Just on that, because Claire mentioned what we're seeing in private credit right now, Claire, maybe you can elaborate on this. Jamie Dimon has said that there are cockroaches starting to emerge in the private credit space. It's been a really, really hot asset class to be involved in over the last couple of years. Are you concerned about what you're seeing in private credit right now? And if so, why?
So look, yes, there's been a huge growth in the last 5 years in private credit. And of course, everybody's focused, and the priority has to be maintaining very high standards, underwriting standards, and credit standards. So we have to focus on that, and on the go forward, that will be the priority. And of course, being transparent and early on. So I think the more transparency that private companies provide to investors, I think that helps investors make their risk decisions about whether they want to participate or not, and that's just will help the market. And look, the Bank of England have announced that they're doing a big system-wide exercise, so it will be interesting to see what the results of that are too.
Anyone else wanted to make a point on private credit before we wrap the conversation up?
The only, I mean, the scope and the need for private credit is definitely undisputable. So the topic is that the growth that we saw in the last few years has been remarkable, but we haven't seen an economic downturn that's proved the resilience of the system. And to me, the real topic will be probably more discovered during a market. I would say an economic downturn will probably allow us to really understand how solid is the market, but we shouldn't really dispute the need of private credit. It's more about how transparent is done and how valuations are aligned between public market and private credit markets.
Okay, unfortunately, we are out of time, so we'll have to leave it there. Ladies and gentlemen, please thank my panel again, and thank you for watching on today.